Let me ask you something uncomfortable. If your business partner died tomorrow, do you know what would happen to your company? Do you know who would own their shares? Because if you don't have a buy-sell agreement in place, here's what could happen. You wake up Monday morning and your new business partner is your deceased partner's spouse. Someone who might not know anything about the industry. Someone who might want to cash out immediately, and you have zero legal protection. I've seen this destroy businesses. In a moment, I'll show you exactly how to prevent it. I'm Rozdeba, the founder of Dundas Wealth. We're an independent brokerage licensed in Canada. We specialize in helping incorporated business owners across Canada use tax-efficient insurance strategies to protect what they've built. Buy-sell agreements funded by life insurance are one of the most important things we set up for business owners with partners. I've been in this industry for years, and I can tell you the businesses that survive the death of a partner are the ones that planned for it. The ones that didn't, gets pretty ugly. By the end of this video, you'll know exactly what a buy-sell agreement is, the three types, how life insurance funds it, and the biggest mistakes people make when setting one up. Let's get into it. A buy-sell agreement is a legally binding contract between business owners. It spells out what happens to someone's ownership stake if they die, become disabled, retire, or want to leave the business. Think of it as a prenup for your business partnership. Without one, you're relying on provincial estate law to figure out who gets those shares. And provincial estate law doesn't care about your business. It cares about the deceased's estate. Those shares become an asset of the estate. They go to whoever is named in the will, usually a spouse or children. And then suddenly you're in business with people you never chose to be in business with. A buy-sell agreement prevents that. It creates a mechanism, agreed on in advance, for the surviving owner to buy out the deceased shares at a fair price. Everyone knows the plan, everyone agrees to the terms, and when the worst happens, the transition is smooth instead of chaotic. But here's the thing. A buy-sell agreement is just a piece of paper if there's no money behind it. Where does the surviving partner get the cash to buy out a $1 million stake? That's where life insurance comes in. And I'll get to that in just a minute. The three types of buy-sell agreements. Let me walk through each one. Type 1, cross-purchase agreement. In a cross-purchase, each partner owns a life insurance policy on the other partner. When one partner dies, the surviving partner receives the death benefit and he uses it to buy the deceased shares from their estate. This works well when you have two partners. It's clean. The surviving partner's cost base in the shares increases by the purchasing price, which is a tax advantage down the road. But if you have 3 or 4 partners, it can get complicated quickly. With 3 partners, you need 6 policies. With 4 partners, you need 12. It becomes an administrative mess. Type 2, entity redemption, corporate purchase. In an entity redemption, the corporation itself owns the life insurance policies and is the beneficiary. When a partner dies, the death benefit goes to the corporation. The corporation then redeems or buys back the deceased partner's shares from the estate. This is simpler from an administrative standpoint. 1 policy per partner owned by the corp. And the death benefit flows through the corporation's capital dividend account, which can create tax efficiencies. But there are tax complexities on the redemption side. The redeemed dividend rules can apply, and you need to structure this carefully with your accountant and your lawyer. Type 3, hybrid agreement. A hybrid agreement gives you flexibility. It might start as a cross-purchase, but allow the corporation to step in and redeem if the individual partner can't complete the buyout. Or it might split the purchase between the individual and the corporation. This is common when partners have different ownership percentages or when the business value is very high. Which type is right for you depends on the partners that you have, the value of the business, the ownership structure, and the tax situation. This is not a DIY decision. You need a lawyer and an insurance advisor working together. How life insurance funds the buy-sell. All right, so you've agreed on a buy-sell structure. Now you need money to actually make it happen. Let's use a concrete example. Mike and Tom own a plumbing business in Hamilton. Equal partners, 50-50. The business is valued at $2 million. That means each partner's share is worth $1 million. They set up a cross-purchase buy-sell agreement. Mike buys $1 million term life policy on Tom's life. Tom buys a $1 million term policy on Mike's life. The annual premiums probably around $1,500 to $2,500 each, depending on their age and health. For a $2 million business, that's a rounding error. Now let's say Tom dies unexpectedly. The insurance company pays Mike $1 million. Mike uses that money to buy Tom's shares from Tom's estate. Mike now owns 100% of the business. Tom's family receives $1 million in cash. The business continues operating. The employees still have jobs. The customers still get served. Nobody is forced into a partnership they didn't choose. Now think about what happens without the insurance. Tom dies. Mike doesn't have $1 million sitting around. He can't buy the shares. Tom's wife inherits 50% of the business. She doesn't know plumbing. She wants her money. Mike might have to sell the business, or take on massive debt, or bring on an outside investor on terrible terms. I've seen all three play out. None of them are good. What happens without a buy-sell agreement? Let me be blunt about what I've seen happen when there's no agreement. Scenario 1. The surviving partner and the deceased family fight over the value of the business. The family thinks it's worth $3 million. The surviving partner thinks it's worth $1.5 million. Lawyers get involved. The business suffers while everyone argues. Clients leave. Revenue drops. The business that was worth $2 million is now worth $800,000 because of the chaos. Scenario 2. The deceased spouse becomes a passive shareholder. They want dividends but don't contribute to the business. The surviving partner is doing all the work but splitting the profits. Resentment builds, the partnership deteriorates. Scenario 3. The family demands an immediate buyout. The surviving partner doesn't have the cash. They're forced to take on debt or sell the business at a discount to competitors. Every single one of these is preventable with a buy-sell agreement funded by life insurance. Every single one. But here's what most people get wrong, and here's what gets interesting. Because even people who have buy-sell agreements often get it wrong. Mistake number 1, not updating the valuation. You signed a buy-sell agreement 10 years ago when the business was worth $500,000. Today, it's worth $2.5 million, but the agreement still says $500,000. The insurance coverage is only $250,000 per partner. You're massively underinsured. The buy-sell agreement needs to be reviewed every 2 or 3 years, and the insurance coverage needs to match the current value. Mistake number 2, using the wrong type of insurance. Term insurance is cheaper and works great for buy-sell agreements when the partner's plan is to eventually sell or retire. But if you're planning to own this business for the rest of your life, you might need permanent coverage. The right choice depends on the exit plan. Mistake number 3, the buy-sell agreement and the insurance don't match. I've seen cases where the agreement says the corporation will redeem the shares, but the insurance is owned personally by the partners. Or the beneficiary designation on the policy doesn't align with the agreement. These mismatches create legal nightmares. Your lawyer, your accountant, and your insurance advisor all need to be on the same page. If you're finding this useful, by the way, hit subscribe. We break down strategies like this for Canadian business owners every week. If this is relevant to your situation, the link is below, dundaswealth.ca/apply. We'll review your partnership structure and make sure you're set up properly. Let me get into the mechanics of setting up an agreement. It's a team effort, and here's the process. Step 1, get your business valued. You need a number everyone can agree on. Use a qualified valuator or agree on a formula, like a multiple of EBITDA or a book value calculation. Step 2, work with a corporate lawyer to draft a buy-sell agreement. This isn't a template from the internet, it's a custom legal document. Step 3, work with an independent insurance broker, like us, to get the right coverage. We compare quotes from Manulife, Sun Life, Canada Life, Industrial Alliance, Equitable to get you the best rates. Step 4, align the insurance with the agreement. Make sure the ownership, beneficiary designations, and coverage amounts all match the terms of the buy-sell agreement. Step 5, review it regularly. Business values change, partners' health changes, life changes. Keep the agreement and the coverage current. All right, let's recap what you've learned. 1, a buy-sell agreement protects your business, your partner's family, and you from the chaos that happens when a co-owner dies without a plan. 2, there are 3 types: cross-purchase, entity redemption, and hybrid, and the right one depends on your business structure. 3, life insurance is the funding mechanism. Without it, Buy-sell agreements are just a promise with no money behind it. If you have a business partner and you don't have a buy-sell agreement, or you have one and it hasn't been reviewed in years, book a free strategy call at dundaswealth.ca/apply. We'll look at your partnership, your business value, and your current coverage, and make sure you're actually protected and not just on paper. I'm Greg Rozdeba from Dundas Wealth. Thanks for watching. Take care of this one. It matters more than you think.